want to talk about two sectors which are sort of at the, center point, if you will, or at the core of the market direction from here. IT on one hand and banks on the other.
So IT, Aisha, the fact is that top line is not a problem at all. In fact, we were one of the big bulls in IT not so long back. In fact, we've been, that's probably our concentrated holding was there from the beginning itself of not only our present offering in the domestic market, but also in our offshore fund, which has been around for a while now. So, but the fact is that top line is not going to be an issue going forward. In fact, if you see the numbers which were reported by most of the guys, the top line wasn't the issue. The issue was not the bottom line, but the margins. Now, we believe that margins going forward. In fact, our view was that the supply chain issues. I mean, as in I'm talking about the supply issues in terms of manpower will even out in the next couple of quarters. Doesn't look like it. So one has to keep a very close eye on the attrition rates, which are very sticky, which we thought will come out, but they've been remaining at those levels for a while now. So one has to be very careful there. And the fact is that even with the global markets opening up, the SG&A expenses are going to move up, traveling costs are going to move up. Obviously, clients are going to look at more on-site presence as such. So that is not working in favor of margins today. So that's why we're being cautious here. Otherwise, as I said, top line is not going to be an issue. But the fact is that let's give it a few quarters and see how they manage that. It's a transition period for the industry, right? So one has to see how they are able to manage. And that's why even today, the exposure that we have is in only tier 1 IT. In fact, any tier 2 which we had, we sold off as such because we believe the tier 1 is the best place to manage this kind of transition going forward. On the banking side, we remain fairly bullish. In fact, the results that came out, you saw ICICI Bank results were fairly good results, or in fact excellent results to put it mildly. But the fact is that this sector, in a rising interest rate scenario, in fact the private banking sector per se is a big beneficiary, right? Let's not go into why, but the reason is obvious. The NIMs have to move up given that most of their lending is in floating rates and their borrowing is more or less CASA or certain deposits which correct over a period of time as such. So that's why the NIMs will move up, and that's why we're so bullish. And the fact is that if the economy is opening up, that's where the real growth, demand growth for the loans and all credit will come in as such. So that's a sector that we are very keenly watching. In fact, we've got massive overweight in that sector.
A lot of comparisons have been drawn that Indian markets are trading at a premium to other markets and also higher than the historical averages. Is it right to do that comparison? Because we are comparing past with future and the circumstances of past and future are different.
No, I think that's a very good point, quite frankly. So if you think about where India is at versus broader emerging markets, we term India as a lucky country. So compared to other emerging markets, I think India is the only one which actually stands out favorably. So I think that's something to acknowledge. That said, just taking a step back on where valuations are at in a relative sense, on earnings estimates in aggregate which are high, the market is trading at say 20 times 2-year forward earnings. That is a 2 standard deviation premium to where India is traded at versus the world, and it's a 3 standard deviation premium to where India is traded at versus emerging markets. So the only point within this we're trying to make is that the backstop from a valuation perspective is full. We don't see any valuation relating incrementally from here, and we'll be selective.
So Mayank, what is the strategy in place? I mean, there are 2 options. One, you can increase the prices, or you can reduce the size of the packet in terms of size or in terms of grammage. What are you doing?
In fact, both happens. So, in the larger packs which are about 20 rupees, you will typically see price hike happening. But the SKUs which are below 20 rupees, typically 5 rupee and 10 rupee as we call it, popular price points, that's where you will see the size of the pack going down. Because, if you have any odd price point, let's say 6 rupee or 11 rupee, there are issues in the market, right from, issue of change to probably, non-standard price point. As a result of which, consumers typically, and even retailers, even trade tries to avoid those kind of SKUs unless they are absolutely essential. So for the smaller SKUs, we will see reduction in weight. However, for larger SKUs which are priced at 20 rupees and above, you will typically see increase in MRP happening.